Welcome to Catalyst. I'm Madison Mills, 30 minutes into your U.S. trading day. Let's get you the three catalysts that we are watching this hour. First up, we'll break down the market action as the risk-on rally takes hold on Wall Street. Plus, one Fed official warning there may be less rate cuts than indicated by the central bank. We'll bring you those details. Plus, here we'll talk the state of the IPO market and how investors can buy into private markets. All that and more coming up on Catalysts. Half an hour into the start of U.S. trading, let's get a check on the markets here. Taking a look at the major averages, you've got a mixed picture, okay? We had stocks moving to the upside this morning. Now you got your S&P 500 just below the flat line. You've got your Dow in the red as well. Your tech-heavy NASDAQ hanging just above the flat line here. We're going to get you that consumer confidence data coming out and just crossing the wires here in a second here. Coming in just below estimates. Maybe that is weighing on stocks a little bit here, though your tech-heavy names are lifting the indexes here a bit. But let's look over at the bond market here. Wouldn't be surprised if we see yields moving to the upside off of the back of that data, and that is exactly what you've got here. Your 10-year up about 4 basis points, hitting around 4.34, coming off its lows earlier in the week off the back of several pieces of economic data. Obviously, we've got consumer confidence, as I said, coming in below expectations here. You've also got new home sales coming in just a tick below expectations as well. Let's get a final look at our favorite risk-on, risk-off indicator in the red. You've got Bitcoin just barely in the red, I should say, but still down on the day at the moment, still holding on to that 87,000 level. I want to welcome in my guest host for the hour, Kenny Polcari. He's the chief market strategist at Slatestone Wealth and the host of Yahoo Finance's podcast, Trader Talk. You'll be with me for the hour. Kenny, I just want to start on the broader market here, obviously fluctuating a bit. Do want to tell our audience about these consumer confidence numbers coming in just below the survey. The survey number was 94. The actual number we got was 92.9. That's also well below the prior month, which was 98.3. Remember, the last consumer confidence number we got really falling off a cliff, leading to a bit of a sell-off. Yep. How much of a sell-off do you think we might get off the back of this?
I'm not so sure you're going to get such a big sell-off because the market has been under pressure, right? I think yesterday's rally was just from an oversold position. I continue to think that we're going to churn, so I'm not surprised to see if the market backs off today. But I don't think it's going to be, I don't think anyone's going to light their hair on fire. But I wouldn't be surprised after yesterday's move, especially if we see the market digest some of that move today based on these numbers.
And I know you do not expect the gains that we've gotten used to over the past 2 days to persist.
No. Well, at least not in the short term, right? Mm-hmm. Listen, I'm bullish as we go through the end of the year, but I think we're going to hit continued volatility at least through the end of the quarter is only 3 days away. So I expect more volatility till then. And then we get the beginning of earnings season, and then we've got tax season. So I think there's some more volatility probably for the next month or so, and then we'll stabilize. But I wouldn't be surprised if we saw us fill the gap from yesterday that was created on the S&P, as well as on the NASDAQ. There was a gap as well, so that should back off. Mm-hmm. But if the data stays kind of the way it is without really falling off the cliff, then I think we start to build a base. And from there, then we advance. If the data starts to get suddenly weaker, then all bets are off. And I would think the market tested the March lows of 5,500.
So I'm curious for you, how much of it is about the economic data versus the policy uncertainty? And the reason that I ask, by the way, just context for our audience, Goldman Sachs saying this morning they do not think that this April 2nd day is going to be less bad than anticipated, and the market's getting a little over their skis on that.
That's interesting because I think I don't agree with that. I think it is going to be less bad. I think that because I think that there are cooler heads in the whole administration. Scott Bessent, some of the other people that are kind of have been thinking about this for a while. That now Trump said it yesterday that he thought that the tariffs were not going to necessarily be as ominous as they originally were planned. It would be much more targeted. So I suspect that while it's going to happen, I think it's going to be short-lived because I think we're going to start to see countries come to the table and want to negotiate on this. Yeah. So I'm not in that camp that I think tariffs are going to send us over the edge again. I am, though, concerned that the economic data might be what people are going to start to focus on because I think they're getting used to this whole tariff idea and they're okay with it for the most part. I think it's going to be the data. If the data continues to weaken or if we see, company after company start missing estimates or cutting guidance and all that, that's going to be, I think, what creates the next move lower.
Yeah, there may be cooler heads in the administration in your view, but one crown, and that's the one that we are watching when it comes to tariff certainty moving forward. Stick with us, Kenny. We're going to have you here for the full hour. The Conference Board's March consumer confidence reading coming in at 92.9, falling about 5 points month over month. February's reading had the largest monthly decline since 2021 as consumers weighed that tariff uncertainty in the first first month of President Trump's term. Here with more on what the data shows us about the consumer, we've got Yelena Shvyatyeva. She's the Conference Board's senior U.S. economist. Yelena, great to have you on here. Talk to me about this number coming in just below the survey estimate, a sign of weakness in the consumer?
Yes, hi, good morning. So yes, definitely, we saw a significant decline. Reading the index has fallen below the recent pretty narrow range it's been hovering around over the last several years. So we see that as a significant move down. That was also driven by expectations. So both present situation and expectations declined, but one of the most significant developments that we have seen was a decline in financial situation expectations from the consumers. So that seems to suggest that all this uncertainty around economic outlook is really starting to weigh on consumers' assessment of how they will fare going forward.
You also have median inflation expectations coming in at 5.1%, up from 4.7% the prior month. Inflation expectations so key to the Federal Reserve, so key to the health of our economy. Are you able to suss out how much of that is driven by tariff headlines?
Tariffs has been mentioned in the write-ins again in this survey, so definitely some of it is coming from tariffs. It could potentially be, prices of eggs, for example, and other food goods. But I think that our survey is also echoing a bunch of other surveys in that respect. And as you mentioned, it's definitely a significant indicator for the Fed. Now, they mentioned, and Chair Powell said that during the press conference, that the long-term inflation expectations remain anchored. If this situation continues and consumers continue to suggest that they are worried about inflation going forward, that could be, a self-fulfilling prophecy, so to say, and we may see inflation rising on those inflation expectations.
So, Yelena, it's Kenny Polcari. Thank you for joining us. Based on that conversation, if inflation is expected to go higher, then do you see the Fed at all in a position to be able to cut rates? Because in that scenario, I don't see it at all.
Our forecast is calling for significant, moderation in GDP growth based off all the uncertainty that we have seen so far. And I think we will continue to see a lot of uncertainty about economic outlook going forward. So in our forecast, we assume that all this uncertainty affects growth to a much larger extent that it affects inflation. And ultimately, by the end of the year, inflation subsides to some degree, given all this economic slowdown that we are expecting.
So given that analysis, then do you expect that we potentially are going to have a situation where the economy enters a stagflation period?
Totally. This is I'm not going to call it a stagflation because, again, long-term inflation expectations remain anchored, and look at market expectations as well. But definitely this stagflation flavor is creating a significant dilemma for the Fed. But at the end of the day, our view is that, weak economic growth prevails and the Fed will have to cut rates, in the second half of the year, just given that the labor market may have to, weaken even further based on all this weakening in the overall economy.
And Yelena, the last time we spoke, you told me that weakness amongst the wealthiest consumers was a key metric to look at. Since we last spoke, we've seen a sell-off in markets, we've seen a market correction. To what extent does that concern you, that the sell-off we're seeing in markets could weigh on economic activity for that top percentage of earners that are really lifting consumer spending right now?
Totally. You mentioned in the beginning of the program that, we see some market reaction to that indicator, right? That was slightly below expectations, but it works the other way around as well. So we have seen in the survey, we have seen a significant impact on the stock market expectations as of late, on the consumer expectations, and that in turn may affect those intentions to purchase from the wealthier sector of the consumer universe.
All right, Yelena, thank you so much. We got to leave it there today. Really appreciate it.
My pleasure.
I'm going to get us a quick check on the market as we head to break here. You're taking a look at still a little bit of a mixed picture, but actually a recovery. We maybe saw a little bit of fear steeping in after the back of the consumer confidence number coming in a little bit worse than expected, but now you're seeing a bit of a recovery back to the upside that we saw earlier this morning pre-market. You've got your S&P just above the flat line. You got your tech-heavy NASDAQ up about 0.1%. Your Dow Jones Industrial Average still under a bit of pressure. We are still seeing a lift in many of those Mag 7 names this morning. Coming up, we're taking a look at some of today's trending tickers, the news behind those moves next on Catalysts.
Monday was an important day for the bulls as stocks touched multi-week highs, but was it just a dead cat bounce, as they call it? I'm Jared Blickery, the host of Stocks in Translation, and for those who are wondering about this odd American saying, a dead cat bounce is simply a short or brief market rebound that happens amid a longer downturn. And to be fair, you really don't know it until you see it in the rear view mirror. But we can do some detective work to make an educated guess, and naturally we start at the scene of the market action. There's no crime here. Does this rally have legs or not? And what we're looking for are small clues that, when you put them together, point towards bullishness. So let's take a look at the market footprints. We have volume and breadth. Those can be key indicators. You want to see broad participation and also higher volume on the breakout, telling you that the pros are in on the action. Investors Business Daily, or IBD, has something they call a follow-through day. You count 4 to 7 days from the most recent market low, and if you get a big update in one of the major indices, and it has to be 1.25% or more, and that happens on higher volume, then that qualifies as a follow-through day. Critically, Monday's rally did not qualify because volume, it was only a fraction of the day before. Now, we talked a little bit about participation, but who's participating exactly? Which sectors are on the move? And is it utilities and healthcare that are leading? That sounds defensive. But Monday's rally was led by Tesla, Palantir, and a bunch of cyclical stocks in technology, retail, and industrials. That adds to the bullish evidence. Now we look for patterns. Are the charts talking? We can look for technical clues. On Monday, the S&P 500 rallied above the 200-day moving average, a key technical indicator, but it stopped short of the January lows, which are arguably more important technically. Sometimes we have a nice price pattern like a double bottom, but it's not necessary, and we don't really have any major patterns to speak of in the indices. Bottom line on the patterns and the technicals in the current context, it is a mixed bag. So we move on and we consider the vibe. Brian Shannon of Alpha Trends likes to say this about bear markets: they either scare you out or they wear you out. And the recent market action and the VIX volatility gauge, that showed some decent fear in the market. And we also saw a little bit of fear in the options market. And then we have investor surveys like the AAII survey, which has been flashing a ton of bearishness over the last few weeks. Survey says, yes, we got some fear, and fear is what bull markets are born out of. So put it together, and unfortunately, there's not a clear signal or answer. We did get quite some participation as measured by volume, but it fell short of that Investors Business Day follow-through day. And there remain some technical hurdles just overhead in the charts. But that doesn't mean that the bounce is over or that we have to go lower. We simply need to do some more detective work as the days and weeks go on. Tune into Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
All right, Jared, thanks so much. It's now time for some of today's trending tickers. Scan the QR code to track the best and worst performing stocks of the day with Yahoo Finance's trending tickers page. First up, Cloudflare. Bank of America analysts double upgrading the stock to buy from underperform, citing the company's improving fundamentals and significant growth potential, saying Cloudflare is poised to be one of the true AI winners in software. You can see that action playing out in the stock here, up about 4% off the back of this note. Kenny, the analyst behind this call, Madeline Brooks, really upgrading here the price target to $160 from the previous street low of just $60, again saying that their differentiated AI positioning leaves high probability for the firm to become an AI leader in software as a service. So I think it's a huge vote of confidence.
I think it's a huge vote of confidence, and Cloudflare is one of the names in the sector that, is one of the key names in the sector, so I'm not surprised at all. It's been a name that we've liked, so I'm glad that she upgraded it, and look at the action today. Investors certainly like the idea.
Yeah, and it's interesting, too, given the competition in the space, that they're still seeing them as such a success story.
Yeah.
Why do you think that is?
I'm not sure why they're suddenly seeing them as a success story, because I think they've been a success story all along. But I'd have to, I didn't see her report. I have to read her report to see kind of what she's looking at.
Yeah.
But one way or the other, I think it's a strong name in the sector.
Yeah, and she talks about, again, their AI capabilities moving forward. I do just also want to mention the street is still pretty mixed on Cloudflare, which is interesting. You got 50% buy, 40% holds here. But next up, we're going to talk about McCormick missing first quarter estimates, price cuts, and promotions not enough to boost sales for the spice maker. The CEO saying the company is, quote, managing a dynamic environment, a great way to not say tariffs. Still, McCormick reaffirming its outlook for the current fiscal year. The stock not struggling too much. It's down about 0.4% here. You got some analyst commentary that I'll point out at the back of this. A lot of neutral ratings here. Equal weight from Barclays, neutral at Citi, saying at this point we do not view the Q1 thesis as changing, but their EPS miss will likely weigh on stocks short term. However, long term, they do see McCormick as part of a pretty crowded space, which also seems bearish.
I think it is a crowded space. Listen, I use McCormick spices when I cook all the time, right? So I like them, but it's not a sexy growth name. It's just kind of one of those consumer staple type names. So I think it's fine, but I wouldn't run right out and necessarily buy it, which doesn't mean I'm negative on the stock. Just means it's not a stock that I own. But I think it is probably a little bit crowded. But again, it's kind of stable. It's boring. It is what it is. Do I think it's going to blow up? No. But to your point, I don't necessarily think that there's a lot of upside at the moment.
Yeah, and they do talk about the impact of U.S. import tariffs on China as a potential headwind. So that's something that you can look at the company for. I look at it as a potential indicator of consumer health, or more people cooking at home, maybe having to up their spice drawer. But again, it's kind of it's a one-time purchase, and
it's
then
a one-time
something for a couple of months at least.
It's not something you go out and buy every week when you go to the store.
Exactly. So again, those shares moving to the downside just a bit this morning. Finally here, GameStop set to report fourth quarter earnings after the close today. Investors focused on updates about the video game retailer's investments, especially involving Bitcoin. You've got your shares of GME down just about 0.5% this morning. Obviously, this is a stock that tends to trade more on vibes than anything else. You've got the shares down about 18% year to date. Heading into the print today, the net sales estimate $1.48 billion when it comes to Bloomberg's consensus here. Taking a look at net sales estimate, that is coming in for 2026 at $3.75 billion. So they do see a bit of a growth story here. Your average analyst price target is $10. That implies a 61% decline from the price as of yesterday's close.
Which doesn't surprise me. I'm not a gamer, so that was not a space I was ever in, but it would not surprise me.
I think tough stock to touch if you.
I don't think for a real investor, someone that's looking to build a long-term portfolio, I don't necessarily think GameStop is a stock you have in the portfolio. But that's me. There may be other people that love the name, but I think there's other places to put your money. You're going to get much more bang for your buck.
Retail traders, options traders, certainly a volatile stock, so maybe it has.
I mean, today traded in and out, but if we're talking as a long-term portfolio, that's not a name that I would include in my portfolio. All
right, you heard it here first, folks. So we're going to have all of your markets action ahead, so stick around for more. You're watching Catalysts. Nearly 1 hour into the start of your trading day, let's get you a check on the markets. Taking a look at the major average here, you're still seeing green on your screen. So we've had a volatile morning, so let's walk you through it. We had pre-market, we were still seeing some gains off the back of 2 days of gains in the S&P 500 after a slew of negative headlines and weighing on your major averages off of that. But now this morning, you had a little bit of a recovery. Then we had consumer confidence coming in worse than anticipated. You saw a little bit of redness off of that, and now we're bouncing back. So you've got your S&P up about 0.1%, your tech-heavy NASDAQ up 0.2%. If we flip the board over to the bond market, you've got yields moving up off the back of that consumer confidence data. If we can take a look at your 10-year actually coming off of its earlier highs, we're hitting around the 4.35 level now. You've got your bond market and your 10-year in particular up just about 2 basis points here, hitting 4.33 on that 10-year. But finally, let's take a look at Bitcoin, our favorite risk-on, risk-off indicator, actually moving further to the downside this morning, off about 0.8%. We'll have more markets coverage after the break. Atlanta Fed President Raphael Bostic now expecting just one rate cut this year, saying in an interview with Bloomberg Television, quote, "We're going to see inflation be very bumpy and not move dramatically and in a clear way to the 2% target because that's being pushed back. I think the appropriate path for policy is also going to have to be pushed back." Bostic also did not embrace Fed Chair Powell's idea of transitory inflation amid tariff policy, saying consumers will likely be more sensitive to higher prices given the recent period of elevated pricing. Joining us now with more, Tiffany Wilding. She's a managing director and economist at PIMCO. And of course, Kenny Polcari is still with me. Tiffany, great to have you on here. Talk to me about your take on Bostic's view there, saying that in his view, we've got one cut instead of two due to tariffs. Powell saying the Fed is not being driven by policy from the White House. At what point does tariff uncertainty start to outweigh the economic data for the Federal Reserve?
Well, I think overall the policies of this administration, at least the focus so far, in trade, immigration policies, does leave the Fed in a very tricky position in that these policies are, detrimental to growth, at least in the near term, and they also likely raise inflation. In terms of the Fed, they have to think about how to weigh those opposing forces. And, I think one issue in terms of the inflationary effects here is that price level adjustments related to tariffs should be just that, price level adjustments. So they're sort of one-off adjustments. They're not higher inflation, ongoing inflation levels. Nevertheless, I think the Fed has to, react to the higher inflation in the near term because it's difficult to disentangle exactly what's tariff related versus what's not. And in addition to that, we've seen pretty unilaterally across surveys that inflation expectations are rising. So short run inflation expectations kind of 1 year ahead have been rising, but even kind of 2 and 3 year ahead, and the University of Michigan 5 year ahead, 5 year inflation expectations, that's also risen. So, I think the Fed has to be, a little bit careful here. Coming off of a period of elevated inflation, you would expect inflation expectations to be a bit more adaptive to new information. And I think that's what they're worried about.
Okay, so Tiffany, what does that mean for your expectations for the Federal Reserve this year and how many rate cuts you're thinking we will have?
Yeah, I think we've been talking about the inflation side of the mandate here, but as I mentioned, the growth side of the mandate, the labor market side of the mandate is potentially, going in the other direction. And that's what we worry about a lot. We do think growth and payroll, average monthly payrolls, labor market momentum, we think both of those things are going to slow dramatically this year, as a result of the immigration and the potential tariff-related disruptions. And so the Fed, again, will have to weigh that. We still think later on this year, there's still going to be room for them to start gradually easing interest rates. And ultimately, if we are surprised and there's more of a downturn, than the Fed or others are expecting, we would expect them to continue. We would expect them to cut aggressively, even if inflation is sticky.
So, Tiffany, it's Kenny Polcari. Thank you for joining us. Let me ask you a quick question. If you see slower growth in the economy, but then you see, this kind of sticky inflation to rising inflation, what's your view then on stagflation for the economy? And is that something that investors really need to be worried about in terms of the market? And then I want to ask you another question after you finish that one.
Well, I think so. Stagflation, I think more definitionally is not just growth slowing and inflation sticky. I think stagflation historically is characterized by, higher inflation during an outright recession or contraction. And, we're not projecting that, and ultimately the size of the tariffs that we've gotten so far, we don't think will drive a meaningful acceleration in inflation if the economy is going in recession. You're still going to have increases in capacity, labor market and broader capacity that will put downward pressure on inflation eventually. So we're not forecasting a stagflationary regime, but nevertheless, I do think these policies still are a bit tricky for the Fed. I think the conversation that we're having, though, is does the Fed cut or do they hold? Right. When do they cut? And if they cut, how deeply do they cut? And I think it's important to keep in mind, just in terms of the distribution of outcomes, we're still not talking about interest rate hikes here.
Yeah, that's funny because I don't think the Fed's going to cut. I don't see how they can cut. I don't think they're going to raise. I think they're going to hold steady. So it's going to be interesting to see how this plays out. But let me ask you another question. Where do you stand on the demands? Again, he came out again yesterday. Trump came out and demanded once again that the Fed lower rates. The Fed should do nothing in terms of what Trump says he wants to happen. But where do you see that playing out, if at all, in the Fed think?
Yeah, I mean, the Fed has been, and I think Powell, in terms of his communications, I think has been very careful to remain arm's length from the fiscal policy, the trade policy, immigration policy discussion. As he's said many times, he wants to stay in his lane. So I think he has been very careful about that. The Fed has a very important history of being an independent institution, and it's uniquely positioned to do that. And I think certainly Fed officials will keep that in mind, keep that front and center as they're making decisions. They'll want to make decisions that are best for the economy.
Yeah.
Now I would caveat all of that, though, with we could have important changes to the Federal Reserve Board and ultimately to the chair in the coming years. You'll have Board Governor Krugler that is up to roll off at the beginning of 2026, and at that point, you have the president, with Senate confirmation hearings, of course, that will put someone else in there that could very well be the next chair. So obviously the views could be evolving, but I think in terms of Chair Powell, he has been very careful to clearly state that he's making decisions independent of what the administration is saying.
Yeah, Tiffany, certainly a lot of uncertainty. In our final minute here, I just want to get your macro view on where you see this economy heading. We have a Deutsche Bank survey showing the U.S. chances of heading for a recession are close to 50-50. What chance would you put of a recession?
Yeah, I mean, so we would argue that recession risks are elevated, in any given year. Just looking at historical instances of recession, maybe there's a 15 to 20% chance of recession. We would say maybe it's a bit elevated than that. Call it like 30 to 35%. But I think we have to continue to remember here that underlying the economy, underlying the confidence shock that we are getting, the trade policy shock that we are getting, is still a pretty strong U.S. economy, in the sense that private sector balance sheets, both consumer and businesses, are really strong, and they came out of the pandemic in a really strong position. Yeah. So, if we do have, more of a downturn, even or a recession, we think ultimately it would be, it would be light. It would be, and we would come out of it relatively quickly, just as a result of those still strong starting conditions, and not clear buildups, at least in the private sector, of leverage.
All right, Tiffany, thank you so much for giving us a little bit of optimism there this morning. Really appreciate it. Well, the IPO market is showing some signs of improvement, with names like CoreWeave, Klarna, StubHub, and eToro all filing to go public in recent weeks. Joining me now with the outlook for the IPO market, Atish Davda, EquityZen's CEO. EquityZen does allow individuals to invest in private markets before companies do go public. So before we get into that, I just want to talk to you, Atish, about how you are seeing the market right now. A lot of euphoria coming into this year about this being a big exit year, and now the word of the year appears to be uncertainty. What will it take for this to continue to be a big exit year?
Well, thanks for having me. Look, IPOs dislike volatility. And if there's one thing that we've seen in the last 5 to 6 weeks, is just a tremendous amount of volatility in the public markets. I think what it's going to take is a bit more clarity. This is exactly what all the management of large companies and small companies alike are asking for. And I think the administration is going to deliver that. They've been clear about how this is going to be a temporary blip that they want. But I think that's what it's going to take for the IPO market to really bounce back.
So, Atish, you think it's going to be then a second half of the year kind of story? Because I think the first, another couple of weeks, 6 weeks or so, I think there's going to be continued volatility. I don't think we're going to get clarity until we hit the summertime and we see how these tariffs have played out, what they've played out, what kind of is happening around the globe in the global economy. So I think, to your point, I think the IPO market, if it's going to heat up this year, it's going to be the second half of the year.
I agree with you completely. Look, over the last 2 years, really last year, a lot of folks have been saying H2, second half of the year, that's when the activity is going to pick up. I actually do think this time is different. I believe that the enthusiasm with which the markets, came roaring out of the gates at the beginning of the year That's still there. There's still a lot of pressure to want to, go public. But I agree with you. I think it's going to probably take a little bit of slowing down, see how some of the dust settles with with the current policies. And I'm excited for what the second half is going to bring.
Yeah, and Atish, I want to talk to you about some news that both of our companies have today. Yahoo Finance teaming up with EquityZen, as you know, and Forge Global to launch a private markets hub. You can find all of the private market and private individual company data on your Yahoo Finance platform, as you can see on your screens there. Some of the biggest private companies in the world, obviously, at the top due to their valuations. You've got SpaceX, OpenAI, for example. Talk to me, Atish, about the interest that investors have right now in private companies and how that makes a partnership like this make sense for investors who are getting a little bit more interested in these private companies.
Absolutely. Super excited about the partnership. Look, EquityZen's been serving private investments to qualified investors for 12, almost 13 years at this point. And our core mission is to bring private markets to the public. One of the key reasons why we're extremely excited about this partnership with Yahoo Finance is it allows us to move that much closer to our mission. Yahoo Finance is synonymous with the excited, enthusiastic, engaged individual investor, and EquityZen is proud to offer the industry's lowest $5,000 minimums. We like to say whether you're investing $5,000 or $5 million into private markets, EquityZen can help support that. One of the key things I want to highlight here as far as this partnership goes is if without access to private companies, most people are limited to investing only in public companies. There's nothing wrong with that, but there's fewer companies that are public than before. We've had a tremendous amount of concentration risk. And the third thing is, if you want to invest in the latest trends, like AI as an example, we're seeing tremendous amount of interest in AI investing. Well, you're not really getting that in public companies, right? Even if you invest in NVIDIA, Microsoft, you name it, it's just a fraction of their actual business.
Right.
If you want to invest in AI companies, as an example, you have to turn to private markets, which is a big reason why EquityZen is proud to enter into this partnership with Yahoo Finance. If you want to invest in innovation, you have to go to where the companies are. It's when they're young, they're nascent, they're being proven out. By the time they hit the public markets, a lot of the valuation gains have already come in. And it's something that we certainly are trying to increase access to for the qualified investor.
Atish, I have to tell you, I'm very excited to be here today during this conversation because as a wealth manager and a wealth advisor, we have a lot of interest coming from some of our clients looking to get into this space. And so actually, you and I are going to have a conversation when this is over because this is very exciting for me to learn about.
So I'm so glad you said that because the wealth management channel has been talking about alternative investments for just such a long time. The last 1-2 years, EquityZen's been talking about this for about 12 years now. And I'm so excited to hear that now the question isn't whether wealth managers will put clients' allocation into these private markets, it's how. And today's partnership that we're announcing is just one of a few, many steps that we're excited about bringing, because ultimately, if you're not investing in the same way that the ultra wealthy are already investing, then you're not going to have access to avenues of wealth creation.
Yeah.
And that's why we're really excited of bringing these opportunities to, the everyday investor, the investor that wants to invest, but doesn't have $10 million and actually has $10,000. Well, that's fantastic. We can get you some, education and access.
I believe as low as $5,000 as well. You can get started. Atish, thank you so much for joining us. Appreciate it. You can find private company data on Yahoo Finance under the Markets tab. You can track valuations, funding rounds, and all of the data that you could ever possibly need to monitor these private companies. Coming up, President Trump announcing a new strategy for his free trade crackdown. He's calling it secondary tariffs. We're breaking down that term after the break on Catalysts. President Trump saying on Truth Social that the U.S. will be putting a, quote, secondary tariff on Venezuela on April 2nd, writing any country that purchases oil and or gas from Venezuela will be forced to pay a 25% tariff to the United States. It's the president's latest update to what he's calling Liberation Day on April 2nd, when he's expected to impose reciprocal and sector-specific tariffs. It is also the deadline for the delayed tariffs on Mexican and Canadian imports here. And I think what's really interesting about what we're seeing unfolding here when it comes to these tariffs is that there was some reporting from the Wall Street Journal, from Bloomberg, that April 2nd would not be as bad. But our internal sources that we have in Washington from our reporters say that that's just the economic side of the White House trying to cool off things for the market, which I think is interesting.
Well, I think it's interesting because I'm in the camp that I don't think it's going to be as bad, right? I think we're going to see, as we move into the second, that we're going to see more negotiating and more kind of dancing around the tariffs. I think we've already started to see that. So I'm in the camp that it's not going to.
What drives that thesis for you that it's not going to be as bad?
Because I think that other countries are going to start to come to the table as it gets closer. They're going to feel the pressure. Look, India's already doing it.
Yeah.
India has already come to the table, and I think that we've seen some movement in Mexico, and so I think you're going to start to see these countries come to the table. I don't think they want to be disrupted, and I think they want to have at least a conversation. And so therefore, I don't think it's going to nearly be as bad. Listen, I'm not saying it's not going to happen. I think the tariffs are going to be imposed, but I think it's going to be short-lived. And so therefore, I don't think it's going to be the issue that a lot of people are concerned about.
Yeah, it's definitely something that I think we want some clarity on. At least investors want some clarity on.
Right, but it's difficult to get the clarity because it changes from one day to the next. But there's a lot of players here, right? That's why it keeps changing.
Yeah, certainly a lot of players. We're going to talk about all of this with our next guest here. Markets recapturing some momentum in recent days as we approach President Trump's April 2nd tariff deadline. Tariff-related uncertainty roiling markets since the president took office in January. For more on this, I want to bring in Philip Luck, CSIS Economics Program Director and former State Department Deputy Chief Economist under the Biden-Harris administration. Thank you so much, Dr. Luck, for being here this morning. Talk to me about this threat of secondary tariffs, sort of a made-up term from the president here. What is the potential impact of that on the tit-for-tat and pending trade war that we are seeing?
Well, you're right. It is a bit of a new term. I mean, he might be borrowing it from the idea of secondary sanctions, which is something we've used in Venezuela and also in the oil industry. The largest importer of Venezuelan oil right now is the PRC. Much of the oil that's being exported by Venezuela is using the exact same shadow fleet that is developed to circumvent the oil price cap in Russia. So basically, anybody who's importing Russian oil right now, they're also probably importing a decent amount of Venezuelan oil. So this would increase tariffs on the PRC, which we've already put on universal tariffs of 20%. So that would probably result in some retaliation and furthering of this trade war.
And as someone who has worked in international trade, the economics of international trade, how do you rate this idea that April 2nd is going to give investors more clarity on tariffs and that maybe April 2nd we will get clarity on negotiations that make these tariffs not so bad for markets?
The only thing I'm sure about of April 2nd is there'll be remaining uncertainty afterwards. I mean, as your previous speaker just mentioned, it may not come in every single way that they've talked about. It kind of can't possibly do so. A full reciprocal tariff regime would be a change of 2.6 million new tariff codes, which is not going to happen. But we'll probably see some increases in tariffs. And I don't think they'll be fully imposed. So it'll increase uncertainty. And I think this is a really key point because to the degree to which we're trying to give our partners incentives to respond to us, if we're trying to give industry incentives to invest in the United States, uncertainty does the exact opposite of that. So this uncertainty is a high cost with really no reward.
Right, but let me ask you a question. If everybody wants to play and try to come to the table the uncertainty, then I think there's a chance that maybe they delay them if there's an honest attempt to have the conversation. That's number one. But number two, let me ask you a question about this additional tariffs on China based on the Venezuelan oil story. If they impose 25% more tariffs on China on top of what's already there, then what do you think happens?
I mean, then you're coming to almost a 50% tariff on all things from the PRC. That's massive.
Right.
And those will be paid by U.S. consumers. So, I mean, that'll be huge supply chain disruptions at that point. So I think that I find that to be unlikely to happen. It's entirely possible that they don't even have a full accounting of where all this Venezuelan oil is going before they made this policy suggestion. So, again, that would be really economically harmful. To your first point about people coming to the table, I mean, that's entirely possible. The only thing I will say is, being here in Washington and talking to our partners at Embassy, they've been coming to the table. They've been coming. They're asking what they need to do to stop this from happening, and they're not getting answers. So from that sense, I really don't think there's much more our partners can do right now because they're not getting clear instruction about what this administration is going to do and what the administration wants them to do.
As an economist as well, though, how do you see this playing out from an economic impact perspective? To what extent do you see the tit for tat on tariffs starting to weigh on the health of the economy?
Absolutely. I mean, this is an own goal in almost every single way. This is bad for our economy. Tariffs are collected on U.S. consumers and producers. This is a tax on Americans. The only way you get this to be paid by somebody else is if the foreign producers lower their price by the amount of the tariff. The evidence we have from the first tariff war and the first Trump administration said that we paid over 90% of these.
Right.
This is a tax on Americans. This will slow the U.S. economy. This is going to be distortive for producers. On top of that, you're going to get retaliation, right? So all the tariff revenue we brought in the first tariff war, 90% of that went right back out the door to bail out farmers who are hurt from retaliation.
Yeah.
So whether or not we end up supporting those who are harmed by the retaliation, that harm exists. So that harm is going to be in the U.S. economy.
Yeah.
The last thing I will note here is that imports and exports, those are the same firms. Half of all firms import and export or do one or the other. So this is massively
Phil, we got to leave it
disruptive.
here, unfortunately, but really appreciate you joining us today and excited to talk with you again soon. Thank you, Phil Luck.
Thanks
and
a
our
lot.
thanks to Kenny Polcari for sitting with me for the hour. Wealth is with you next.